Hi guys, and welcome to our podcast. Today we're going to be discussing certificates of deposit, or CDs. What exactly are they? How do they work? And are they good investment options? Let's start with a fact. Banks are constantly trying to seduce people into putting their money into the bank. For this, they offer their clients to pay them for doing so. This is known as a deposit. Are certificates of deposit a good investment option for you? The answer is not simple. It depends on the bank, the terms they offer, and you as an investor. On the positive side, CDs give people a steady and predictable income in the form of interest rate. On the downside, it locks your money for a set period of time, 3 months, 6 months, a year, etc. So, what are CDs? How do they work? What are their pros and cons? And how many types are there? Let's start. What are certificates of deposits, or CDs? A certificate of deposit, or CD, is a contract between a bank and a depositor for a fixed period of time. The latter is called term. The depositor entrusts his money to the bank, and for this, it pays an interest rate to the deposit owner. Usually, people buy deposit accounts because they have some spare money that they do not need in the near future. If the term of your CD is 1 year after it expires, the bank will pay the interest rate on the money. A deposit owner should pay taxes on the returns unless the account is tax-free or tax-deferred. Bear in mind that CDs are low-risk and low-return investments and are not suitable for people who need cash at the moment. Why? Well, if your bank is insured by the Federal Deposit Insurance Corporation, FDIC, and is under $250,000, then your deposit is also insured. If the bank goes bankrupt, the FDIC will give your money back. There's nothing as helpful as a good example. So let's say that John has saved $5,000 which he does not need in the near future. Then he decides to buy a CD at a 2.5% compounded interest rate. The term of the deposit is 2 years. If John withdraws money from his deposit account before the end of the second year, he will have to pay a penalty. For the first year, John will receive $125 in interest, $5,000 times 2.5%. For the second year, he will receive $128. $5,125 times 2.5%. And the whole amount of money after the maturity date will be $5,253. It's easier than you think. So, how is the interest rate distributed? It depends on the bank and the contract you have signed. There are CDs that offer the interest rate to be paid each month or once every 3 months. The money is deposited into the account. More often, banks pay the interest rate they owe on the account holder when the term ends. Sometimes, which is tricky, CDs will roll over. This means that your contract is automatically renewed and your CD extends for a new term. The interest rate changes, however, and usually equals the current market one. If this is the case, end the contract on the day it expires and open a new one at better terms. My advice is to know very well what kind of CD is your deposit account and all of the details concerning penalties, interest rate, term, rollover, etc. Now, let's talk about ladders. CD laddering is a very common strategy. The deposit owner benefits from high interest rates, usually typical for a long-term CD, and has access at the same time to his funds. Simply said, you get high rates without locking your money for 3, 5, or more years. The process of laddering includes buying several CDs with different terms. Instead of having one which rolls over at the end of the set period, you can have several deposits. For instance, let's take a look at John again. He has $5,000 in extra cash, but he's not sure if he will not be needing this money in a year or two. Therefore, he uses the above-mentioned technique. He opens 5 CDs and invests $1,000 in each of them. The first one has a year maturity, the second a 2-year, the third has a 3, the fourth 4, and the fifth 5-year terms, respectively. After the CD expires, John opens a new 5-year deposit. Then, next year, his second deposit expires and he buys a new 5-year deposit. In this way, he ensures that each year he has a deposit that matures, taking advantage of the higher interest rates. Now, let's review the disadvantages and risks related to a CD. The first pitfall is the early withdrawal penalty. As we mentioned, CDs have a preliminary set framework, term and interest rate. Should you withdraw money before the term ends, this may cause a penalty. The amount of this penalty depends on the money you have withdrawn as well as the deposit and the bank. Usually the institution that issues the deposit charges several months' worth of interest. For instance, a 12-month CD's penalty might be 3 months of the annual interest on the money. Keep in mind, Sometimes there is a grace period during which early withdrawals are not sanctioned. Another disadvantage is the fact that your money is actually locked. Once you put your money in a CD, you cannot touch it until the maturity ends. If you withdraw money earlier than that, there will be penalties. This means that the whole idea of having a deposit seems meaningless. In my opinion, only people who do not need the money in the foreseeable future should invest in a CD. Inflation risk is another thing we have to consider. Ultimately, this is the greatest risk to a CD. Why? This is particularly risky when you have a traditional CD with a fixed rate and an early withdrawal penalty. Let's imagine the interest you earn is 2% on the amount of money. However, this is the same year inflation rises by 2%. This means that you have not made any profit whatsoever. Sometimes the interest rate could be even lower. They have been pretty low recently, almost close to 1%, than the rate of inflation. A problematic situation can happen in case of bank failure. If a bank goes bankrupt, this is not a great day for deposit holders. Yes, the FDIC insures most deposits, but it depends on the CD issuers as well as the amount of money. As previously mentioned, the FDIC covers only deposits up to $250,000. There are many different types of CDs. The first most common one is a traditional CD. This is the most common type, and its characteristics are fixed term, like 3 months, 6 months, a year, etc., a fixed interest rate, for example, 1.5%. If you withdraw before the maturity ends, you have to pay a penalty, and protection by the FDIC if the deposit does not exceed $250,000. Stockbrokers and financial institutions may also offer deposits, and they are called brokered. Actually, they represent a bank's offers, including those of online banking institutions. As a rule, brokered CDs are high return, riskier, and with a longer term. In addition, not all of them are FDIC insured and might require a fee when purchasing the account. Moreover, there is sometimes a minimum limit of, for example, $10,000 to open one of these CDs. CDs which do not offer a fixed interest rate are called variable or flexible rate CDs. These usually carry a higher risk and potential for greater returns. Normally, a person would buy a variable rate CD with a longer term. There is an option of bumping up, which allows the account holder to adjust the interest rate according to market conditions. It's important to know how many times you can bump up and when. Be sure to know all the details, including when the interest is distributed. I would recommend this time to people who know the market very well. This is important because a person should know when exactly to adjust the interest rate and benefit the most. Liquid CDs are deposits which allow the account holder to pull out some of the money without paying a penalty. In order to take out money without an early distribution penalty, however, you have to follow some withdrawal limits. For this reason, these CDs offer lower interest rates. Zero coupon CD is another type of CD. The typical thing about this kind is that it does not pay interest annually, but it rather distributes the amount after the end of the term. Bank offers zero coupon CDs at great discounts, but you will have to pay taxes on the income. These CDs tend to offer higher rates. The last type I would like to discuss is the callable CD. Usually brokers offer these types of CDs. The specific thing is that they contain a call feature. Now, what is a call feature? If the deposit has a term of 3 years, then the bank might decide to end the contract prior to expiration. Of course, there is a protection period, for example 6 months. If the bank does that, they have to pay the owner his money as well as the interest earned during that period. In the bottom line, if you're wondering whether to open a CD, you should consider the following. Are you going to need that money in the near future? Remember, a CD locks your money for a preliminary set period of time. Do you want to invest short term, or do you have plans in the long run? Do you prefer lower returns and lower risk, or do you want to make a higher profit for a shorter period of time? Are you aware of the potential risks that deposits carry? Answer these questions, and then go ahead and decide your next steps. But that's it for now. On our website, you can find more posts and podcasts, as well as calculators and other online financial tools. Do you believe in the certificates of deposit as an investment? We would love to know your thoughts, so feel free to share them in the comments below. I hope you enjoyed it. Don't forget to subscribe to our podcast channel on YouTube, and we'll see you next time.